Shankar Sharma now joins us, and he joins us after a really long time. Shankar, fantastic to have you back, and thank you for joining us. Shankar, do you think today's correction is the beginning of what could be called as a prolonged, painful period for global financial markets? Because selling is just not restricted to equities. Bonds have gone up, volatility has gone higher, and also crude has come down.
My view is, I don't think this is a reversal. I think it's only a correction. So I think we should not be reading too much into it. From the lows of February, markets have been more or less, on a one-way trend up. So within that pretty large move, I mean, the emerging market index itself is up, if I'm not mistaken, something like 20-odd%. In fact, about 25% from the lows in dollar terms. I mean, when you have rallied 25% in 5-6 months' time, I mean, to expect that there cannot be a correction of 3-4%, even 5%, is being obviously ignoring the way markets work. So my sense is this is only a correction. This is not a reversal. Not in India and not in emerging markets. I think both are looking very good. And I would, take the view that these are opportunities that markets present quite regularly, and you have to take advantage of these.
Shankar, are you not worried about what Fed may do and what really could be the outcome of the US presidential election? I can throw in the China angle. So good old concerns which have haunted us in the beginning of 2016 and for the entire 2015, what are the chances that those good old concerns could come back?
Those concerns, in my view, will be restricted largely to the US markets, and I don't think you will see a spillover of that into emerging. Because China in February, or in fact last year, middle of the year, from that level, China has fallen. It actually fell, I think, close to 50%, or at least 40-45%. Even now, China is down maybe about 20-odd% from the levels we saw, around the middle of the year last year. So it's not that we are buying or we are saying that these markets have, have taken out all-time highs and hence they're at very dangerous levels. I mean, China has just bounced back from very abysmal low. That's nowhere close to being into bubble territory, at least from a stock market perspective. So where you have a problem will be the US markets, which are at highs. The emerging markets are not at highs. So I don't think the problems will come to emerging markets. I think relatively speaking, emerging markets will outperform. And if you look at the last 6 months, they have been outperforming. The trend is quite strong in favor of emerging. Look at Russia, look at Brazil, look at China, look at India. They have all been pretty good markets, in particular the beaten down markets like, China, Brazil and Russia. India has just started doing well in the last 1 month or so. Before that, it was kind of flattish, but it was not bearish for sure. So I think the problems you mentioned will be restricted to the US and not really affect, the emerging market end of it.
Shankar, what we've seen post-Brexit is that we've seen a strong wave of flows which have moved back into emerging markets. And it's not only India, all emerging markets are moving up. It's a rising tide which is taking all boats higher. So do you think Indian markets are simply benefiting because of flow towards emerging market, or this time around it's different and India is uniquely positioned?
I don't think India is uniquely positioned. I think India is benefiting from an overall sentiment change towards emerging markets, and that usually happens when you had 4 or 5 long, painful years for emerging markets overall, wherein they have really been disappointing in terms of returns and relative returns both. That cycle changed, I think, from the lows of February, which is where my view was that I think emerging markets will now start to outperform, and I think that trend will be, not a 6-month trend. I think it's a longer-term trend, probably a couple of years at least. So within that context, India is benefiting. So I don't think we should just, again, always keep looking at India as something which is from a different planet. We will benefit or we will suffer based on what is broadly a trend for or against emerging markets. And I think the trend is for emerging markets for sure. And within that, India also has been, doing okay. Other markets have done a lot better, mainly because they were beaten down last year. But India started performing, as I said, in the last month or so. And I think the trend looks very strong in favor of India and emerging markets overall, for sure.
Shankar, so do you think the The outcome of US presidential election, irrespective of who's going to be the next US president, is going to be more like a 1 week event. It will let us a lot of headline, but from a market standpoint, it doesn't matter.
It doesn't matter. I think we just kind of, get caught up in all these things which are very, very peripheral to, basic economics, and which is, earnings and inflation and interest rates. And if you look at India, if you're talking India per se, the bond yields are at 7%. If you recall, the last couple of years, even a little longer, I have said that India is basically a cost of capital trade, wherein I don't think growth really reviving or earnings growth really coming back into the mid-teens kind of levels that people have been forecasting. But what I do see is a big fall in bond yields. And that time it was about, I think, 7.7, nearly 8. From there, we are down to about 7%. And that itself will act as a floor for this market, and which is really what India is all about, and which is really what the world has been all about. The world has not seen growth of any measure in the last 7-8 years, but the equity markets have done phenomenally well because the cost of capital has declined. So growth can happen two ways, or other growth in equities can happen two ways. Either the hurdle rate comes down or growth goes up. In this case, the hurdle rate is now down. Growth has not gone anywhere, but remained tepid or even negative. But just the discount rates have come down to nearly 0% or 1%. So everything looks good relative to the discount rate. So India, again, because of a sharp fall in bond yields, as has been my view for the last few years, is doing well. I don't think we should read too much into that and start to extrapolate that and say the economy itself has turned or numbers itself will come and surprise us on the upside. I think we should hold our horses on that. But from a purely equity market perspective, if your hurdle rates, which are bond yield as a base, if they come down, then as an alternate, equities will look good. And that's precisely why India in the last 1 month, 1.5 months has been doing relatively quite well.
In your mind, what really could be the base for the Nifty? Do you think somewhere closer to 8,000 Nifty will find a lot of support? And for those who've been waiting for a dip, today could be a good buying opportunity?
Yeah, I think today is a good buying opportunity. Maybe tomorrow too. I think rather than look for a precise point on the Nifty, I think this correction, in any case, globally was overdue. As I said, 25% rally from the lows of February. You should be prepared for a 4-5% kind of correction. And that's what we are seeing right now. I don't think we should read too much into it and say this is a reversal. At least that's my view. I could be wrong, but my view is this is only a correction and not a reversal.
Shankar, last time when we interacted with you, and it was way back actually in the month of March, and that time your view was that it's time to revisit the dirty picture, which is metals and some infra names. And my compliments, because metal stocks from the March lows have come up. Most of the infrastructure road companies are up anywhere between 40 to 50%. So do you think this high beta trade adjustment is over, or metals and infra names still have a long way to go?
No, I think they have quite a bit of distance to go, given how crushed they were in February and March, and that's been the space that I have been focused on within the small cap space. Also, metal infra and stuff that has been unloved, have done the best, and I still believe there's a lot of legs to that end of the market. I mean, as we have also spoken, the large cap end of the market will not give you anything earth-shattering in terms of returns. Because you need genuine 7-8% economic growth for them, and I don't think that's going to happen. But the small caps and the beaten down small caps have done phenomenally well, not just the last 6 months or the last 2 years. I think that rally still continues. Given these small corrections, where you can lose 5, 10, 20% in a stock in a week, that's part and parcel. So be prepared for that. I still think there's a long way to go for all these names.
Shankar, you've always sort of raised a red flag when it comes to financials. Now, you're bullish on India. Financials account for nearly 35 to 38% of the index weightage now. So, if financials will not do well, do you think Indian markets will struggle?
Yeah, which is precisely why the large caps don't appear very attractive to me. I mean, not to say that they're going to go into a bear market or anything of that sort. Far from it. But they will not give you eye-popping returns as the smaller end of the market will. And that's because you have financials and you have IT and you have pharma. IT and pharma's problems we understand, we all know. And financials obviously over-owned. I don't think they can give you 20-25%, on a compounded basis as an aggregate in the large cap space. Although mid-cap, small-cap financials, have been in a different world altogether. So that's why the large cap indices are not going to give you anything very substantial. But even then, such corrections will provide you opportunities where you can make a little bit of excess returns if you've timed the market right. And I think that's where the skill will lie in making money out of large caps, rather than in the small caps where a buy and hold is working very well.
Shankar, the consensus view on street is that small cap stocks are trading at P multiples which are higher than large cap. It is a situation where the tail is wagging the dog rather than the dog is wagging the tail. Are you not worried about the underlying price action and the valuation froth which has appeared up in the small caps?
And Nikunj, I've always said that I don't at all ever look at valuations. I think this is all made up by analysts to justify their monthly paychecks. There is nothing to say why something is expensive at 19 times and why something is cheap at 16 times. Valuation works if you're looking at extremes. So something 5 times, something 60 times, then you're talking, those are valuation extremes. But within a range of 15 to 25 times earnings, who's to say 15 is right and 25 is wrong? Small caps are benefiting from very strong balance sheet restructuring, very strong earnings growth, very strong revival in ROEs and ROCs. So I see no reason why they should not trade at a premium to the large caps. So I mean, why do we always have to think of the large caps as being the dog and the small caps as being the tail? Maybe the whole story has changed right under our nose.
Okay, Shankar, I'll quickly change the gears of the discussion and talk about commodities. When crude was at 110, you were the first man on the street you said that crude is a short. When crude, I think, was at $36, $37, you were the first guy who said crude is a buy. So what is your view on commodities and particularly crude?
I remain optimistic broadly on the commodity complex. And, crude, fell from 100 odd to 27, 28, which is when, I publicly said that this is, a great buy. From there, it has gone up 70, 80%. I think, immediate upside, if you're talking maybe, $5 or so is about all you can look at. But I don't think they're going to go back to the levels of the mid-20s or even the low 30s. I mean, that would be, very, very, in my view, a remote possibility. So I'm generally optimistic on this, on the commodity complex, and which is why I'm optimistic on emerging markets overall. So that's broadly where the trade is playing out.
Over the years I've interacted with you, and that's nearly 15 years now, I've realized one thing, that you always believe in cycles. You always do tape reading. So what is the screen telling you? Where is leadership in this market?
The leadership in the unloved and the unowned, under-owned sectors of the market, and that's been the small caps broadly, and that's been emerging markets overall if you're looking at a global macro. And both spaces have surprised us, and they will continue to surprise. I'm very, very sure about it. The consensus trade was US long, emerging market short. That trade is now coming apart. People will fight it. People will say this is all flash in the pan. In my view, emerging markets are going to outperform globally. And within that, India's small cap look, as I've again said last 2 years, they're the best equity class in the world without exception. And I continue to hold that view.
So you always use, let me take a leaf from your from our last interaction. You said that in March 2016, it was Indian markets were like, there was a Jekyll and a Hyde situation for Indian markets. So where is the Jekyll right now and where is the Hyde for Indian markets?
I think both are quite looking like Jekyll. I don't think there is a Hyde now, given this correction. So I'm quite happy that we've seen this sell-off. It is giving you an opportunity. I don't really think there is a Mr. Hyde right now in the Indian markets.
Never heard you that bullish, Shankar. I've never heard you that bullish in last 1 year.
No, I mean, we spoke in February, and I was equally bullish when the markets, I think, sold off quite a bit, and I continue to believe that even now. So really nothing has changed in my view, and I have been prepared for this correction. These things will keep happening, and we kind of romanticize it, but I think you are in a bull market in emerging markets overall for sure.
Shankar, why are historical correlations getting disjointed? The bond market is telling me a different story. Gold prices are indicating something else. Equity markets are sitting at a new high, which means that equity market participants are pricing in the beginning of a new cycle. Now, historically, if I connect the dots here, I'm not being able to connect the dots here. So why do you think historical correlation, as we speak, they've got disjointed?
Because that's the nature of markets. Nikunj. Everybody gets comfortable in a notion. Markets start to trade as if everybody understands the future very well, and that's exactly when consensus breaks down. So these correlations are only good up to the point they last, and one fine day they will just break, and people will start to ask these questions. What you're asking, that why suddenly the whole world changed?
No wonder, Shankar, you've been bearish on telecom for a long, long time.
Yeah, but I mean, that's okay. I mean, it was, every sector has a certain shelf life, and unfortunately, the best before date for telecom was 2007, and that's from there it has basically done nothing. And I've always maintained that it's an ultimate commodity business. It's even worse than a commodity like steel or iron ore or aluminium, because you have no locational advantages in telecom. You can put up a tower, I can put up a tower, as long as both of us have got the same license and similar spectrum. There's nothing to differentiate between two providers. We can keep saying X service is better than Y, but ultimately everybody hates the telecom providers from a service angle. I don't think anybody's happy with their telecom provider, irrespective of whether they are an MNC or a local Indian company. So it's a commodity business. Commodity business can't make returns of 27%, as they were in 2007. And we can see that now they've been decimated to low single-digit return on capital. And with the entrance, of Reliance Jio, one can only, feel for the incumbents that it is going to be even more painful than it has been in the past. And then the other thing is, when you start to make those kind of profits, then in a regulated business where your government is controlling the strings of the game, then the government starts to extract its own taxes. And so the spectrum keeps taking away huge capital into the government coffers, away from the private sector. So ability to invest keeps declining. In a regulated business, making so much profit is almost always going to be a recipe for government intervention, and which is what we have seen.
Shankar, you've always maintained that Indian auto companies are great and outstanding businesses. You've liked Tata Motors in the past. You've liked Bajaj Auto in the past. You've been bullish on Maruti as well. Given the way how consumption patterns are shaping up and the fact that we've had a good monsoon this year, interest rates are coming down, I mean, all the ingredients are there in the melting pot. So do you think auto stocks also have a long, long way to go, at least the big ones?
Yeah, for sure. I mean, that is fortunately so far, hanging in there and looking very good. And, India broadly, if you just look at the domestic part, is still hugely underowned in terms of motor vehicle penetration, like abysmally underowned. So if you look at the broad top-down macro for autos in India, it can only go one way, and which is up. You will have, small periods of, low growth or negative growth also, maybe for a month or a quarter or whatever. But just, step back and take a look at the amount of vehicle ownership in India for 125, 130 crore population. Yeah, I think you're what, maybe, two-wheelers might 10, 12, 13 crore, 14 crore, something like that. Autos are, like a fifth of that. So you're looking at like a huge secular move which will last many, many, many years. And this, fortunately, is not a regulated business like telecom is. It is a free market business where you have branding, you have capacity, you have ability to make it at a low cost. You will win. You don't require government support or the lack of it to win at this game, which is what I like about this business. It is a consumer business wherein the marketplace and efficiencies of your own operations will decide whether you win or lose. And therein the winners are very clear. And if you look at the global picture, Tata Motors numbers have been phenomenal. And again, it's coming from a low base overall in luxury, which is where it was in 2009-10 also. It still has a long way to go in terms of market share gains versus, the other more established players like, Benz and BMW. So Tata Motors is a good story. Maruti is a great story. Bajaj Auto is a good story. I mean, so these are, barring a little bit of, squiggles here or there for a quarter or two. I think all of them are pretty good long-term stories, without any doubt.
Do you think that one-time trading bounce in PSU banks is behind us? Most of the PSU banks, they are up anywhere between 50 to 90% from the recent lows.
Well, I mean, like I said that banking is something that I'm extremely leery of at most times. Yes, I mean crush down valuations. You can have rallies of this kind. There are two ways to look at it. Whether the NPS cycle, the worst has already happened and it's behind. So one can say maybe, but that's only one part of it. The second part is growth. So I am not interested in buying a bank merely because the balance sheet hit or the balance sheet risk is over. I'm interested in buying a stock for growth. Now, do we see asset growth, loan growth coming back into the banking system, into PSU banks? At least I don't see it. Maybe somebody else does, but I don't see credit growth picking up. So the balance sheet part of it has probably bottomed out, which is why you've seen the rally. But the P&L part of it, I mean, I think, it's still too early to start to say that earnings numbers, growth numbers will be very strong for these banks. So they were good enough for a 50% move, which is what we have seen. I don't think they're good enough for a 500% move.
Amongst all your classic calls, one Shankar Sharma classic in 2015 was when you said you are bullish on specialty chemicals. And my immediate response was a big no, because nobody likes specialty chemicals. They are low margin business. But I guess I was wrong and you were right, because the specialty chemical clan per se has exhibited extraordinary strength. What's going on there?
So I think, again, it's a big trend shift. The China versus India play. I think Indian companies are finding that, they can compete with China. They can collaborate with China. In China, because of plant shutdowns, capacities are being shrunk. Maybe they will start to look at India, to outsource their manufacturing, which will again help Indian companies. So there are big global shifts happening in the chemical space. And I think Indian companies are now beginning to gain some degree of scale on a global basis. I mean, I think there's still a long way to go, but I think that is again a secular trend up. Obviously the sector went through a lot of difficulty, in the sort of 2010 to 2013, 14 era. So managements have learned, they have now learned to work with, other industry participants rather than work against. So overall, I think, that's a good space. I continue to like that space.
Shankar, I know I've extended my appointment with you, but let me summarize our today's interaction. Your view is that corrections are a good buying opportunity. Emerging market as an asset class will outperform. Money will rotate out of US markets, and India will clearly emerge as one of the best performing emerging markets.
India, China, Russia, Brazil, all looking very good.
Shankar, and thank you for joining us on a very important day, and good to have you back on this forum.
Great. Thanks very much, Nikunj.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.